Welcome to Iron Financial. We're here to help you forge a stronger portfolio and cut right through the market weakness. I'm your lead analyst.
And I'm your market skeptic. Today, we are putting an absolute giant under the microscope, Western Union. Look, this isn't just some company. It's a global institution. But right now, it is at a serious crossroads.
That's exactly right. The entire structure is showing major signs of stress, but at the same time, management is trying to completely reforge the company from the inside out. So the big question for us and for your money is whether that foundation is strong enough to handle the heat of that forge, or if it's all about to crumble under the pressure. Let's dive in. Okay, let's just cut to the chase and talk about the number that's got everyone buzzing. A dividend yield sitting over 10%. Now, in this kind of market, a number that high screams one of two things, and only two things. It's either the most incredible, overlooked value opportunity on the board, or it's a classic textbook value trap. A yield that high is often a massive red flag. It's the market's way of screaming that the payout is unsustainable and that a dividend cut is probably just waiting around the corner. So, which is it? Is this a yield of real strength, or is it a siren song trying to lure your portfolio onto the rocks? That's the core question we are going to answer today. And to get to the bottom of it, we have to break this down piece by piece. First, we're going to examine the cracks in the foundation that are showing up in their latest earnings report. Then we'll build the full bear case. Is this just a temporary problem, or is it a sign of deep structural rot? After that, we're going to switch gears and construct the bull case, looking at how they're trying to forge a new core, and we'll look at their huge bet on digital reinvention. And finally, we'll put it all on the scales and deliver our final verdict. All right, let's start with the damage report. You can't even begin to think about the future without first assessing the damage in the here and now. And believe me, when you look at Western Union's latest Q1 report, it's like the Richter scale went off. This wasn't some minor stumble. This was a full-on barrage of bad news that absolutely hammered investor confidence. Let's get into the numbers that show you just how deep these cracks really go. Let's start with the headline shocker, because this one is a doozy. Wall Street, the collection of analysts who do this for a living, was expecting 45 cents in earnings per share. Western Union came in and delivered just 25 cents. Let me be clear, that is not a miss. That is a catastrophic failure. They missed the mark by nearly 45%. When a mature blue chip name like this, a company that's supposed to be stable and predictable, misses estimates by that wide of a margin, well, it tells you something fundamental has completely broken down. It means one of two things. Either management has absolutely no visibility into their own business, or the business is deteriorating faster than they can possibly control it. Either way you slice it, it's a huge red flag. And this wasn't just about failing to meet outside expectations. The internal decay, what's happening inside the company itself, is just as alarming, if not more so. If we look at it on a GAAP basis, and that's the generally accepted accounting principles, the standardized audited numbers you can't really fudge, earnings per share collapsed by a staggering 44% year over year. It cratered from 36 cents a year ago all the way down to just 20 cents. So this isn't an expectations problem. This is an internal profitability collapse. The company's engine is just not generating the power it used to. It's sputtering. And that kind of sharp downward velocity is exactly what spooks the market and makes you seriously question the long-term health of the entire business model. And here's the reason why that profit is collapsing. It all comes down to the operating margin. This number is the lifeblood. It's the core profitability of the actual business, how much money they make on every single dollar of sales before you even get to things like taxes and interest payments. Last year, they were sitting at a very respectable 18%. This quarter, it cratered down to 13%. That is a 500 basis point compression in a single year. That is a massive erosion of profitability. It means the sales they are managing to make are becoming less and less profitable, which is likely a toxic combination of their own costs going up and getting hit with fierce pricing pressure from new, hungry competitors. This points directly to a decaying core, a clear sign the business is weakening under immense pressure. And just to round out this ugly picture, it wasn't only about profit. The top line itself, the total revenue coming in the door, also came in light. They missed the consensus by a pretty significant margin. What this tells you is that the slowdown is happening even faster than the most pessimistic analysts on Wall Street were predicting. So when you have a massive earnings miss, you have collapsing margins, and you have a revenue miss on top of it all, that's the trifecta of a disastrous quarter. It paints a very clear picture of a company that is struggling on all fronts, and it sets the stage perfectly for the full bear case. So Okay, the earnings report clearly shows us the immediate cracks. They're obvious. But the bear case argues that this isn't just one bad quarter. It's a symptom of a much deeper structural rot. The argument is that the very things that made Western Union a global powerhouse for a century, its massive physical footprint, its total dominance in cash transactions, are now becoming huge liabilities in a world that is moving digital at lightning speed. Let's dig into the external forces and the expert consensus that suggests this company was built for a world that is, frankly, rapidly disappearing. And look, you don't have to take my word for it. This quote from the analysts at Cantor Fitzgerald cuts right to the absolute heart of the bear thesis. They say the brick and mortar network is a structural disadvantage. Think about that. For decades, that global network of hundreds of thousands of agents was their fortress. It was their impenetrable moat that no one could cross. But today, the bears argue that it's a ball and chain. It is incredibly expensive to maintain, it's slower than digital alternatives, and it's constantly being outmaneuvered by these nimble digital-first competitors who don't have to carry that massive overhead. So what was once their greatest asset is now, arguably, their biggest vulnerability. Now, let's talk about a direct hit from regulators, because this is huge. This new 1% remittance tax is nothing short of a surgical strike aimed directly at Western Union's business model. Let's be very specific. The tax applies to cash, money orders, and cashier's checks, the absolute core, the bread and butter of their legacy retail operation. But it conveniently exempts debit cards, bank accounts, and digital wallets. Those are the very channels that their new digital competitors specialize in. So the government has effectively penalized Western Union's main product while giving a complete free pass to its rivals. This creates a powerful financial incentive for customers to switch to digital platforms, which just accelerates the exact trend that is already eroding their business. This is a massive, undeniable headwind. And if you're still not convinced of the bear case, just look at Wall Street's official verdict. Out of the 14 professional analysts who cover the stock day in and day out, how many of them have a buy rating on it? The answer is 0. A big, fat 0. Not a single one. In fact, 5 of them have an outright sell, and the other 9 are basically on the fence with a hold. The consensus rating is reduce. When the so-called experts, the people who are paid to do nothing but analyze this one company, are this uniformly bearish, it tells you that the risks here are very real and they're not just theoretical. Any turnaround is going to be a steep, uphill battle fought against a massive wall of skepticism. Okay, that is a brutal, brutal bear case. I get it. A cracking foundation, evidence of structural rot, and a deeply skeptical Wall Street. It paints a very bleak picture. But it's only half of the story. The bull case argues that while the old Western Union is absolutely under pressure, management is not just sitting on their hands watching it all crumble. They are in the forge. They are hammering out a new, more resilient core for the company, and they are using the river of cash flow from that legacy business to fund a very strategic pivot. So now, let's look at the bright spots, the strategic reinforcements, and the hidden growth engines that bulls believe are going to define the future of this company. If you look beneath those ugly headline numbers, you find a company that's in the middle of a massive transition. Yes, the core consumer money transfer business, which includes that struggling retail segment we talked about, was down 3%. That's what the bears are laser focused on. But look at the other pieces of the business. The consumer services segment, this includes things like bill payments in their travel money business, it grew by a massive 24%. And their own branded digital business, their direct competitor to the fintechs, grew a very solid 9%. The bull argument is that this is the future. They are building new pillars of growth that are already expanding at a rapid pace. The idea is that these new pillars will eventually become large enough to more than offset the decline of the legacy business and return the entire company to growth. And they are not just trying to build this new core organically, which would take forever. They are aggressively using M&A, mergers and acquisitions, to accelerate this transformation. Each one of these deals is a calculated, strategic move to reinforce a specific part of a plan. The Intermex deal, for example, is designed to shore up their retail presence in the critical Americas corridors. The Lana and Dash acquisitions are pure digital plays, buying them ready-made digital wallet capabilities in key growth markets like Mexico and Southeast Asia. And the Eurochange deal plugs directly into and helps scale their fast-growing travel money business. You see, this isn't random spending. It's a series of targeted strikes to buy technology, to buy market access, and to buy new revenue streams to speed up this critical pivot. Okay, I'll grant you, the M&A is targeted, and a $150 million efficiency program, that's not chump change. They clearly know the margins are under intense pressure, and they are taking action. But here's the question. Is this just trimming a little fat around the edges, or is it a desperate attempt to bail water while the ship is sinking? They say they plan to pull out $150 million in costs by 2028, but their operating income just dropped by over $50 million in a single quarter.
This is a race against time, and it's not at all clear if the cost-cutting can actually keep pace with the margin erosion that's happening in their core business.
That's a fair point, but you have to remember that a turnaround of this magnitude doesn't happen in a vacuum. The macroeconomic environment matters a lot. And these economic forecasts running through 2028 actually show stable, moderate GDP growth and unemployment rates that are holding steady or even declining slightly. Now, remittances, the absolute lifeblood of their business, are heavily correlated with these economic factors. A strong job market in sending countries means more people have more money to send home. So the Bolt case argues that this stable economic backdrop provides the perfect runway for their turnaround. They aren't trying to execute this incredibly difficult pivot while simultaneously fighting a deep recession. They actually have a bit of a tailwind, or at the very least, a lack of a headwind, which gives them the time and the economic stability they need for these strategic initiatives to finally take root.
So the bull case rests on these new growth segments, smart M&A, and a stable economy. But there's one more massive piece to this puzzle, and it's their biggest swing for the fences yet. It's the wild card. It's the move that could either accelerate their reinvention into a true fintech leader or prove to be a costly, damaging distraction. I'm talking about their deep dive into the world of digital assets, stablecoins, and crypto. This is their attempt to not just adapt to the digital world, but to try and leapfrog the competition entirely by building a bridge between the traditional financial system and the emerging world of blockchain technology.
And at the very center of this new strategy is their own stablecoin, which is called USDPT. Now, to be perfectly clear, a stablecoin is simply a type of cryptocurrency whose value is pegged to another asset, in this case, the US dollar. So what they're building is a digital token that functions exactly like a dollar but can move on modern blockchain rails. The initial plan is to use it for settling transactions between their own agents all over the globe, which could potentially offer a faster, cheaper, and way more efficient alternative to the old, clunky SWIFT banking network. This is a massive play to completely overhaul their own internal plumbing. And here's how they plan to connect this new internal system to actual customers, through something they call the Digital Asset Network, or DAN. So imagine a user has some cryptocurrency in a partner's digital wallet. They can initiate a transfer. Western Union's DAN then settles that transaction using blockchain technology. And here's the crucial part. The recipient on the other end doesn't need to know a thing about crypto. They just go to a physical Western Union location, like they always have, and pick up their local currency in cash. In effect, they're leveraging their old physical network as the last mile for the new digital world. It's an ambitious plan to become the essential on-ramp and off-ramp between the world of crypto and the world of cash.
Okay, we've laid it all out on the table. We have seen the deep, undeniable cracks in the foundation, and we have heard the powerful bear case for a company that might be in structural decline.
But we've also constructed the bull case, a company that is actively in the process of forging a new core through very targeted growth, strategic acquisitions, and this huge wildcard bet on digital assets.
So now it is time for the final verdict. We have to put all of this evidence on the scales. Is that 10% dividend a massive opportunity staring us in the face? Or is it the ultimate value trap?
And this slide really sums up the entire battle. In the bear column, the cracks, you have the undeniable reality of what's happening today. A massive earnings miss, collapsing margins, a core business that is shrinking, a hostile regulatory tax specifically targeting them, and an analyst community that is overwhelmingly skeptical. The cracks are deep, and they are very, very real.
But on the other side, in the bull column, the reinforcements. You have the promise of tomorrow. You have legitimate high-growth segments in digital and consumer services. You have an aggressive M&A strategy that's designed to accelerate the pivot. They're cutting costs. And crucially, despite that terrible quarter, they reaffirm their full-year guidance, which suggests they believe Q1 was the absolute low point. And then, of course, you have the digital asset wildcard, a very high-risk but potentially very high-reward play that could fundamentally transform the company.
So here it is, the bottom line. Western Union is a company at war with itself. The decaying legacy business is acting as the bank to fund the birth of a new, more modern company. They are in the forge, and they are attempting one of the most difficult maneuvers in the entire business world, transforming a legacy giant into a nimble digital competitor. The potential reward, if they pull it off, is enormous. You're buying into a massive turnaround story at what could be the moment of maximum pessimism, with a huge dividend to pay you while you wait for it to play out.
But the risks are just as immense. Let's be honest, turnarounds like this are brutal, and they fail more often than they succeed. The old business could decay much faster than the new one can grow, which could lead to a dividend cut and a further collapse in the share price. The forge is a very dangerous place to be.
Ultimately, they are trying to forge an entirely new company from the inside out. And the final question for you as an investor is this: can your portfolio handle the heat of the forge?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.